Hi guys, welcome back. AI might be the future, but it's still mostly powered by machines from the past. Gas turbines. Now the demand is spiking, supply can't keep up, and prices are projected to triple. But what most investors miss is that just 3 companies control the global gas turbine production. I am talking about Mitsubishi Heavy Industries, GE Vernova, and Siemens Energy. And in this video, I'll first break down why this market is pretty interesting right now, and then dive into the details of each of these companies to see which one could be the best investment in the space and can benefit the most from this growth and the forming bottleneck. And if you're new here, my name is Florian. Thank you for joining me today. So we all have heard by now that AI will be driving the power demand. A study from Goldman Sachs shows that each ChatGPT query needs almost 10 times as much electricity as a Google search. With this, it is no wonder that they expect an increase in power demand of 160% until 2030 from data centers alone, and even 200% increase until 2035. And this is pretty interesting because when we look at the historical data, here from the NRDC that published a report on how to manage data center load growth just a couple of weeks ago, we see that in the past 20 years, there wasn't much growth in energy demand at all. The projections from here on out show quite an increase for the next 10 years. These figures are for the US only, but they look pretty similar for Europe. Even the most pessimistic scenario shows a significantly quicker growth than what we had in the recent years. Now, AI may be a big part of this increase, but it is by far not the only one. Other trends like the electrification of cars, climate control, and even industrial applications are also expected to drive this demand for more and more energy significantly. Of course, renewables are carrying an increasing part of this and have even tripled their share of US electricity generation over the past decade. But they still only make up 15% of the overall energy mix, while natural gas makes up more than 40%. And with Trump's new energy policy that has already led to billions in clean energy projects cancelled, I wouldn't expect that this gets much better, at least in the near term. And the US is not alone with this. Germany also wants to build as many as 20 new gas power plants until 2030, and Japan, China, and Vietnam are also considering building new facilities. Saudi Arabia is even planning to invest hundreds of billions of dollars for power, of which roughly 1/3 is reserved for gas power plants, according to this Bloomberg article. But it's not only governments that are pushing the need for gas power. Even private data center companies like Elon Musk's XAI have recently turned to using more and more gas turbines to power their immense data centers and fuel the quick growth that would otherwise not be possible in many cases. And this has already led to what Bloomberg calls a gas turbine crunch, with the orders outpacing the production capacity for these pretty complex parts of machinery. Industry experts even think that this huge order increase and the resulting global gas turbine shortage presents a significant and potentially overlooked threat. Now, this doesn't sound too good for the AI build-up or also for the energy prices. But for us investors, a potential material bottleneck could be a great investment chance, especially if it is still overlooked by many people. And the risk, but also the investment chance, is only further enhanced by the fact that only 3 companies produce over 2/3 of all gas turbines worldwide. And as mentioned in the beginning, these 3 companies are the Japanese Mitsubishi Heavy Industry, the German Siemens Energy, and GE Vernova from the US. And with the general increase in energy demand, the market for these gas turbines specifically is also expected to grow by 7% annually for the next 5 years. This growth, combined with the limited production capacity that is also not easily expanded because of the high complexity of these turbines and the supply chain, will lead to a 20% increase of build time as NextEra Energy, the biggest electric utility company by market capitalization worldwide, pointed out in their last earnings report. And they also expect the cost for these turbines to roughly triple until 2030 compared to the price of 2021. So all of these 3 companies have significant secular tailwinds, at least in this segment. But that doesn't necessarily mean that they are also a great investment. So next, let's see how much the gas turbine business even makes up from their total business, and then have a look at the fundamentals to see if an investment even makes sense and which of these 3 companies currently looks most attractive. And first, I looked at the 2024 annual reports for our 3 companies and then calculated how big the portion of the gas turbine business makes up from their total revenue. Unfortunately, the fiscal years of these 3 companies are a bit different. So the time frames over which these revenues were generated are also a bit different. But I still think that it's good enough for our comparison. And as we see here, the turbine business has the smallest share for Mitsubishi with only 13.6% of the total revenue. For Siemens, it's about 1/4 of the total revenue, while it even almost makes up 1/3 of the revenues for GE Vernova. So the impact on GE should be the biggest from these 3. But even though it takes a while and requires significant capex costs, Mitsubishi has already started to expand their production capacity, and they are planning to further increase this by 30%, as they mentioned in the last analyst call in August. And because their order books are already filled to the brim, this should directly result in a revenue increase as well as an increase of this portion of the business as soon as the increased capacity comes online. And while we're speaking of Mitsubishi, let's also look at the financials. First of all, we see that the stock already had quite a good run recently and is up by over 80% in the last 12 months alone. Their income numbers did also go up, but not nearly as much as their stock price did. Their net income, free cash flow and EPS also reached their highest levels ever, but we also see quite a high fluctuation here, especially in the free cash flow, and the uptrend is pretty choppy. One of the reasons for this is the capex heavy nature of the industry that requires them to make quite large investments on a regular basis. We see here that Mitsubishi tries to keep the yearly capex cost on roughly 50% of the operating cash flow. But their margins are quite good for the industry and the highest of our 3 companies today. Only in terms of ROIC, they are lagging behind a bit, as we'll see in a moment. And of course, we also can't compare these margins to companies like Microsoft or Nvidia. The industry is just totally different, so we can't expect the same high margins as we see in software or big tech companies that are often even way above 50%, at least for gross and EBITDA margin. But the balance sheet looks good with only 0.95 times net debt to EBITDA ratio and an interest coverage ratio of 16 times. They also have a decent chunk of cash on their hands that is currently even more than double the company's yearly free cash flow. So they do have quite some money available for further investments or to return it to their shareholders. But what they have not done so far is to use the cash for share buybacks. Their share count is very stable over the whole history here, and there weren't any big moves in either direction. Mitsubishi does pay a dividend with a small yield of currently 0.66% though. But they could grow this dividend with an average of 18.3% per year in the last 5 years, while still keeping the cash flow payout ratio at only 27%. But despite this growth looking nice on average, they still cut their dividend in 2022, which only leaves 3 consecutive years of growth. And when we look at the history, we see that the company does this from time to time. So instead of focusing on growth, they try to keep their payout ratio steady, which in some years leads to lower dividend payments. This is different to how US companies usually handle their dividends, and something to keep in mind because it also means that investors might not be getting dividend increases every year. And even though their recent dividend growth in general was pretty high, the dividend is still at the lowest level of at least the last 5 years, which is also an indication that the company is already pretty expensive right now. And when we look at the valuation category in my rating system, we also see that Mitsubishi does indeed have quite a high valuation. Only the price to free cash flow doesn't seem to be too bad. But on the other hand, they have the momentum on their side and get very high scores here, which balances the high valuation at least somewhat. And this is also reflected in the opinion of analysts that see a very limited 1-year upside with the stock. In fact, on average, they only think that the stock has a 1-year upside of 2.3%, which leaves me to wonder why they still give a buy rating for the stock, with most of them actually giving a strong buy rating. Of course, we compare the scores of all our 3 companies in the end. But first, let's also see how the fundamentals of our other 2 companies look. And unfortunately here it gets a bit complicated, because neither of them has a long history. GE Vernova was just listed in April last year as a own company, and Siemens Energy was spun off from Siemens almost exactly 5 years ago. But here we also don't yet have the fundamental numbers for the full 5 years. So in neither of these cases I can calculate a proper 5 and 10-year growth score with my system. The only numbers that I do have are the EPS and the revenue forecast, which also means that the growth score for both of them will be rather low and not really comparable. Of course, this also affects the final score, and I think it doesn't make sense to compare it here. But we can still compare each other category individually to see where they are standing in this regard. This is also something I'm still looking into and debating on how to improve my scoring system in a way that also lets me rank younger companies without a long history. In the end, this is just the first version of my system and I will absolutely further improve it over time. And by the way, huge shout out to Mohammed, the CEO of Dadymore, that built this dashboard with me. It was an absolute blast to work with you on this, and thanks for all the ideas and improvement suggestions that you also brought to the table. But back to our analysis. When we jump into my dashboard in TradingView and look at the income of GE Vernova, we also see that there is not much income or growth to look at. The same is true for the margins, but for the 1 year of data that we have, they could slightly improve the margins across the board. But these margins are all below the ones of Mitsubishi Heavy Industries. Only the ROIC is above that of Mitsubishi and is even the highest from our 3 companies today. Their balance sheet also shows a bit of a mixed picture. They have enough cash on their hand to pay back most of their long-term debt. This also brings the net debt to EBITDA ratio to a -4, which is very good. But on the other hand, they also have a negative interest coverage ratio, which is far less good. But considering the large amount of cash, this shouldn't lead to problems, at least in the short run. They still need to monitor and increase the operating income so that they can start covering these expenses from their operations and not from their savings. So, as I said, for the growth numbers I can only put in the EPS and revenue forecast. These numbers do look quite good, especially the EPS forecast. But the final growth score here is still pretty meaningless without the rest of the numbers. We can, however, calculate all other scores and see where they stand here. Their financial health and profitability score, for example, is quite mediocre, with 5.2 for 5 years and 5.35 for 10 years, which reflects the mixed picture that we just saw. And the same is true for the dividend score. GE Vernova is paying a very small dividend and also has a very low payout ratio. But because of the very short history, we don't have any dividend growth and also 0 years of stability so far. They do have a decent quality score though, with their large moat, low customer concentration and secular trends in their backs. But they are also operating in a cyclical industry and only have an average ROIC and only return a very small amount of the cash to shareholders via dividends. They did recently start a share buyback program this year and have been actively buying back shares. But unfortunately this is not yet reflected in the numbers that I have up to now. The valuation and momentum category looks pretty similar to Mitsubishi's. We also have quite high scores in momentum, but the valuation is even higher than theirs. Especially the PEG ratio with a value of 7 seems to be rather high at the moment. Analysts, however, are still a little bit bullish on the stock with an average 1-year upside of over 8%. And this brings me to Siemens Energy. And here we have at least a little bit of a history. And from what we see here, they show a steady growth in top line as well as bottom line growth. We have an outlier in 2023 where several of their metrics went down quite a bit. But this was due to some quality problems in their Siemens Gamesa wind turbines that generated extra warranty and repair costs. But without these effects, the company seems to be growing quite nicely. Their revenue even grew with double digits last year. And we see a similar picture with their margins. Here we also have a general uptrend, but we also can see the dip in 2023 numbers. Still, Siemens Energy has the lowest margin of all 3 companies today, but their business model is also much more focused than the other 2 that also cover other industrial applications and not only focus on machines for energy generation as Siemens Energy does. Their balance sheet actually looks very similar to the one of GE. They also have quite some cash on their hands, which pushes the net debt to EBITDA ratio into negative values. But same as GE, they also have a negative interest coverage ratio, although in their case it is pretty close to zero. Where they differ though is the share dilution. While GE has kept this stable and even started to buy back shares already, Siemens has issued new shares a couple of times now, and especially in the last 2 years. So they also get quite a mixed score in health and profitability, which is even lower than that of GE and reflects the weaker margins and higher share dilution. They are also not paying a dividend, which also gives them the lowest score of our 3 companies in this category. And even their quality score is a bit lower compared to the other twos because of their higher concentration on the energy business that is quite cyclical. And I also gave them a lower manager quality score because of the high share dilution and low ROIC. But at least they do have a wide moat and low customer concentration, same as the other two. The general picture in valuation and momentum looks again similar to the other two, with a strong momentum and a weaker valuation. But in this case, despite the valuation being high, it is not as bad as our other companies, and especially the PEG ratio and the price to free cash flow multiple look quite a bit better compared to the other two. So at least in this category, they get the best score. And again, as I said, I don't have the fundamentals for the last 5 years, but at least the EPS and the revenue forecast also looks pretty promising in the double digits. Their revenue forecast is even the highest one today. But again, the 1-year price target from analysts is also roughly on the same level as the stock price today. So in the short term, they don't see a big upside. So while the general picture looks pretty similar for all 3 companies today, there are some smaller differences, especially when it comes to financial health and profitability and their strategy to return cash to their shareholders. So before I sum this up, let's also compare their scores directly to each other. And if you like the video so far, please hit the like button and subscribe to the channel. We are so close to 1000 subs now, so who knows? You might just be the one who pushes us over the edge. So thank you very much. And now, let's see how these companies compare directly against each other. I will ignore the overall score and the growth scores for the reasons that I already explained. But even from the remaining categories, Mitsubishi gets the best score overall, with GE coming in at second, mostly due to the health and profitability score. The only category where Siemens Energy can score is the valuation and momentum. But we also see that all our companies are rather mediocre and in many categories even get a red score. So if you ask me, despite the strong tailwinds, the bottleneck in gas turbines and the rising energy demand due to AI, I still think that there are better investments to find at more reasonable valuations. To me, it looks like the bottleneck and growth expectation is already fully priced in at today's prices. But if you would force me to choose any of these 3 companies today, I would choose Siemens Energy despite them having the lowest score. And it's not because they are a German company. For my single stock investments, I just like companies with a clear and concentrated business model. And GE and even more so Mitsubishi have both a rather diversified business model and are active in multiple markets. This makes it much harder for me to follow them and keep up with what's going on. The difference in their scores is not enough for me to make an exception to this fundamental view, especially when we consider that I couldn't even calculate a growth score for them. I mean, growth is the main thing that Siemens and Vernova both have going for them, and it's not included in the score. But again, I think there are better chances out there, even if you want to play the AI energy angle. There are some utility companies, for example, that are not that expensive. And guys, if you want to know which small and unknown company in the surgical robotic space I am buying right now, and of which analysts think that the stock could go up by 50% in the next year alone, check out this video right here. And of course, this is no financial advice. So please, before investing, do your own research and only use this video as a starting point for your own analysis. That being said, thank you so much for watching, guys, and see you in the next video.